And at the end, one of them, on behalf of the audience, presented me with this gift. This is a heavy chunk of copper. Feel that?
Yeah, that's oh wow, it is pure.
That is native copper. The markets, I think, are somewhat mistaking the opportunity here, but I think most people get it so much for these other reasons we've been talking about. The idea is buy low, sell high. I bought low years ago. I sold high earlier this year, and less high is not low. Lower is not low. I mean, think about it. We're plus or minus $4,000. When we hit $4,000 on the way up, people are popping champagne bottles. Woohoo, $4,000. Now we hit $4,000 on the way down. People are crying into their beers. Woe is me. But that's not really low. You know, the gold mines, the producers today, those mines were designed and built sub 2000. They are printing cash in the real sense in this market. So yeah, yes, they're relatively on sale. But relatively on sale is not the deep discount route. I think it's going higher. Doesn't mean it can't go lower first. So my base case, people want to call me names, Darth this, Darth that, but I'm not actually a bear. My base case right now is actually a period of correction and consolidation, and the next big move will be higher. That is my expectation. Not my prediction. I don't know the future, but that's what I think is the most likely thing. But if that's true, correction and consolidation, last time in 2020, when we first hit 2000, it lasted 3 years. Where's my sense of urgency to buy the dip today if we're in a period of correction and consolidation? There is no. I want to wait for what looks like an objective opportunity to buy low. What really upsets people is that I point out that there are some similarities to the peak this year, to the one in 2011, and I mean chart peaks, similarities, and also even 1980. Again, I'm not predicting, I'm not calling the market top. I'm not saying January of 2026 was like January of 1980. But the data suggests it would be imprudent to ignore the possibility. And if that's a possibility on the table, where's my sense of urgency to buy in front of that? Right. So, I don't want it to happen, but if it does, now think about this. Here's the other side. If I go back in now and gold doubles again, okay, I'll make some money. I'll make more money. But if we pull a 2011 or a 1980 and gold halves before going back up again, and I've got the cash to buy that dip, I'll make 10x. Like the difference between buying high and selling higher and buying low and selling high is the sort of thing that can add a zero to your net worth. So I don't know how it's going to play out.
But you want.
But if that chance is there to add that zero to my net worth, I'm going to want to have the cash to take advantage of it. And sorry, just one more real quick thing. In 2008, when everything was falling off a cliff and gold dropped almost $700 an ounce, we could all see it. We all knew it was wrong-headed. It was the wrong reason. Gold had to come back, or we thought we knew, right? And it did. But I was illiquid. I didn't buy any stocks during that crash. And by the way, we are talking stocks. I haven't sold any bullion at all.
Yeah. Okay.
Just unlike our host here.
One of investing's oldest principles is simple: buy low and sell high. Yet many investors struggle to follow it because emotions often replace discipline. Assets that seem expensive after strong rallies can still climb higher, while those that appear cheap may continue falling before recovering. Successful investors avoid chasing headlines and instead wait for prices that offer a favorable balance between risk and reward. Building cash reserves during strong markets provides flexibility when genuine opportunities appear. Patience is not inactivity, it is preparation. Waiting for quality assets to reach attractive valuations has historically produced stronger long-term returns than buying during periods of excitement.
I like the turtlenecks because I don't have to iron them.
Right.
The chain is there because I made a promise, I kid you not, 48 years ago not to take it off. And so it's still there. And to me, this says something about the kind of person I am. I had a reception for readers last night. I didn't realize Rick Roll was speaking at the same time, but too late to change things. And I still had over 50 people show up. And at the end, one of them, on behalf of the audience, presented me with this gift. This is a heavy chunk of copper. Feel that?
Yeah, that's oh wow, it is pure.
That is native copper. So to all my critics out there on YouTube about my turtlenecks and my chains, here you go, brothers.
I love it.
6 and change down to 6. Yeah. That's not buy low. No. $6 copper was your all-time high not so long ago. So no, but your framing of the question is excellent, because copper, the whole setup for copper, we probably don't need to rehash all the fundamentals. The audience is probably aware, like structural deficits as far as the eye can see. Philo is a great discovery but the last one before that was 10 years before that. We need a couple of those every year. I mean, everybody knows all this stuff. But recently, copper has become one of these picks and shovels plays for AI. And it is true that the data centers need a lot of copper. But the reason to go long copper is not because of the data centers or even the EVs before. But to the degree that the current bullishness for copper or the pricing in the copper market on the futures market is driven by the AI narrative, there's good potential for that to go into reverse. I mean, as we speak, we have already some retrenching. There's some questioning like, well, where's the ROI going to be? Do we really need all this build out? Meta is starting saying, well, maybe we're going to rent out some of our compute. We're not sure we need all this. Well, if Meta's renting out excess compute, why do we need to build $1 trillion worth of data centers? Or DeepSeek, right? Suddenly, maybe we don't need all. So the point is, if the AI story goes into reverse or blows up, the bubble blows up, we could see a sale in copper. And I would love to take advantage of that. I'm very, very bullish, but I don't want to buy high and sell higher. I want to buy low.
And I mean, you're not buying the metal itself. You do buy, but on the future side. But are you? What about the miners?
Yeah, no. I'm talking miners.
Yeah, okay.
I'm willing to stick gold and maybe some silver under my mattress. It's actually the third palm tree on the left, not the mattress. Don't rob my house, please. It's not there.
Commodity markets are driven by powerful economic cycles rather than steady upward trends. Gold, copper, uranium, and energy have all experienced periods of rapid gains, followed by lengthy consolidations before resuming higher. Even industries supported by strong long-term fundamentals can temporarily decline as market sentiment changes. Artificial intelligence, electrification, and infrastructure spending continue supporting demand for industrial metals, but short-term enthusiasm can sometimes inflate prices faster than fundamentals justify. Investors who understand these cycles recognize that temporary corrections are not necessarily signs of weakness. Instead, they often create the conditions for stronger and more sustainable advances later in the cycle.
Takes a lot of copper, though.
Yeah, but I'm not going to do that with copper. Certainly not uranium.
Yeah, no kidding.
So no, actually, I don't worry about the metals. I suppose if I was very cautious, very bullish on copper, but didn't want to risk a mining company, get nationalized or something, then I might buy a copper ETF for the metal. But I've never done that. I'm seeking alpha, so I'm looking at the mining stocks. But anyway, so I think there's a good chance that the AI bubble gives me that buy low opportunity. If not, then right now as we speak, we've got the war sort of reheating in the Middle East, and if that continues, that's going to be bad for Dr. Copper, industrial medicine. If it really blows up again, if Trump's latest is I'm done, I've had enough. These are scum. There's no point in negotiations. They're a waste of time, right? If he means that, I don't know if he ever means anything he says, but if he means that, and the war really reignites, that's another vector for potentially sale prices in copper. I don't know if either of these will happen, but I do know that I want to buy low. And if the market comes to me on this, great, I'll buy. And if not, segue into something else. Let's say no AI bubble burst, no war reinflating, copper gets away from me, and I'm left on the shore watching the ship sail away. Fine. In that scenario, oil goes down. And that's what's on my shopping list right now.
Really?
Yeah.
Copper remains one of the world's most important industrial metals, powering electric vehicles, renewable energy systems, transmission networks, and expanding data centers. At the same time, artificial intelligence has created enormous expectations for future electricity demand. However, markets occasionally become overly optimistic, causing prices to move ahead of reality. If AI investment slows or infrastructure spending becomes more measured, commodity prices could temporarily weaken despite strong long-term demand. Meanwhile, energy markets continue responding to geopolitical developments, production decisions, and economic growth. For investors, these fluctuations may create attractive entry points without changing the broader long-term investment thesis.
So I want to buy low. I did actually dip my toe in the water last week. I bought, first time I bought a stock in months.
Energy, oil?
Oil. He's oil, yeah. And right now, I actually had a whole shopping list, half a dozen stocks. I only got one because I didn't think we were, quite there. It was lower, but not really low. That one company seemed oversold to me. The other ones were just relatively, right? I don't want relative, I want low. And so this week the market's going against me. People are saying, "Hey, great timing on that buy right before the market went up," and I'm thinking, "Dang, I only got 1 out of the 6, right?" But for whatever it's worth, like the futures market right now is telling us that the war is over, and even with flare-ups along the way, investors writ large clearly expect, and perhaps with good reason. The United States at least, we understand that until the midterms, there's a high incentive to see oil prices go lower. We also had that big rush of ships out of the strait once it semi-reopened. That oil is going to be starting to hit the refineries like next week.
Yeah.
And even now, the Hormuz tracker says that the strait is closed, but there are 57 ships in transit. And those are the ones with their transponders on. So how closed is that? Long story short, I do have a very bullish thesis on oil, sort of medium to long term. But I think in the near term, the odds favor a shopping opportunity. And the pair trade here, what I really like about the situation, this is actionable for now to your audience. Like, the war either continues or it doesn't. It cools off or it doesn't. It's kind of binary. You can waffle in the middle only so long before it goes one way or the other. And that's beneficial to either one of my energy picks, or actually I like uranium too, but right now we're talking copper and oil.
Canadian, U.S.? I know you won't give me the stock ticker, Lobo, but you can give me the country.
If things go the way they're going now, I think we get a sale price in in oil. If they continue roughly the way they are, not today, oil blipped up, yesterday, actually it's off again today. But if they go the way they've been trending recently, I think I get a chance to execute my current shopping list in the oil patch. If I'm wrong, then I think that puts my copper shopping list, plan B,
Interesting.
in play.
I got to ask natural gas. Do you touch that?
It's more regional.
Yeah.
Regionally I do like it. I like LNG better because it's more globally fungible. But it's kind of one of those so obvious plays that the obvious beneficiaries are not that much on sale.
Yeah.
Global electricity demand continues rising as artificial intelligence, cloud computing, manufacturing, and electrification reshape the economy. To meet these needs while reducing carbon emissions, many countries are expanding their nuclear energy programs or extending the lives of existing reactors. Uranium therefore remains an increasingly strategic resource. Although uranium prices have experienced volatility, long-term contracts between producers and utilities continue supporting industry fundamentals. Governments in North America, Europe, and Asia have also increased support for nuclear energy as part of broader energy security strategies. These developments continue reinforcing uranium's role in the evolving global energy transition.
Unfortunately, I don't think people are that wrong about it. Well, okay. To the degree that there are some Johnny-come-latelys in the story because it's also perceived as an AI picks and shovels play. And we saw this in spades last year, just over a year ago, when the DeepSeek moment came out, and there were uranium stocks. Oh, suddenly AI is going to be more efficient, won't need any energy. Like, none. And we literally had blue chips in that space go from 52-week highs to 52-week lows on that news. Completely wrong. And all-time highs not long afterwards. So I would love to see the market make that mistake again. I'm not sure they will, but if they did, it would be an absolute gift wrap with a giant bow on it. I would love that. But actually, I think the writing is so clearly on the wall. The AI hype is maybe overdone, but it is true that you need this power. And with the pushback against the data centers providing jobs and stuff, great. Taking all our power and jacking up our power bills, not so much. And so you got to build your own power. Trump is taking, a victory lap on having invented the idea of providing your own power. But he's actually kind of walking the talk.
Yeah.
We saw they were targeting 3 new advanced reactor designs to be tested by July 4th, 250th anniversary, great photo op. They brought 4 online. So, I'm an anarcho-libertarian. I don't want handouts from the government. I'm always aware of those scary words in the English language. I'm from the government. I'm here to help, right? But it sure beats having a hostile government to have a friendly government to the industry. And that really is night and day.
Now, do you hit the uranium odds, or are you hitting something tertiary, like, picks and shovels, SMRs, things like that?
Yeah, no SMRs for me. That's another one that, I might have. Well, some of those companies had a thumbs up or clause up in my take service, but I didn't personally buy them. I got the story, but And now, all of the ones in that space have gotten so much love. Again, I don't want to buy high and hope to sell higher. So, boy, we've gotten off this track. But to your question, the markets, I think, are somewhat mistaking the opportunity here. But I think most people get it so much for these other reasons we've been talking about, the support and, the spot price. At $85, I can't call that low. It's certainly enough that it's continued to incent new production. But here's the interesting thing, and this is a takeaway for the audience, like right now. Spot has been below the long-term contract price pretty much all year. There was this wacky surge early in the year for a day, and then it came back, and it's been dragging along underneath the long-term contract price, which is the real price. That's what the actual consumers pay the miners for the stuff. That never lasts. The spot will, it's more volatile. It'll shoot higher and lower, but it always comes back to the long-term price over in time. And right now, it's been below long-term contract for months. So I think there's potential for a snap move up in spot, which does tend to move the stocks. So on the one hand, I can't say they're super cheap. It's not like buy low, but there is actually a near-term catalyst that could push them all higher. If I was a trader, I'd probably, go long now on that basis. As a long-term bull, right now, after having sold my gold and silver stocks, my portfolio is almost entirely uranium. So I'm not feeling any sense of urgency here. I'm already, locked and loaded for this. But if I didn't have any uranium at all, because of this near-term catalyst, I would probably remedy that like this week. I would find a dip to buy right away if I didn't have any uranium.
Do you look at like a uranium trust? Do you look at a Sprott, something like that?
Several answers. For me, I'm seeking alpha, so I'm not really looking at that. But if I'm on a fixed income, and I can't afford to lose my nest egg, but I like uranium, absolutely. That's where I would go. So that's one size doesn't fit all.
Successful investing is not about predicting every market move. It is about managing risk while staying focused on long-term objectives. Markets will always experience periods of fear, optimism, volatility, and uncertainty. Investors who maintain discipline, diversify thoughtfully, and avoid emotional decisions are often better positioned to benefit from future opportunities. Whether investing in precious metals, energy, uranium, or industrial commodities, understanding market cycles is more valuable than attempting to time every short-term fluctuation. As global economic trends continue evolving, patience, research, and sound risk management remain the most reliable tools for building wealth through changing market conditions.